Hello traders, Gary Wagner here. It is approximately 10:30 in Honolulu, 3:30 in New York. It is Thursday, the 19th day of January 2012, and this is the daily report for gold and silver. We have a mixed bag today in the marketplace. A nominal positive gain in silver, currently up about 4 or 5 cents. And gold coming off of the lows from this morning, trading off or down about $4 on the day. Traders, I am going to start by looking at a 30-minute straightforward candlestick chart. This is of the spot market or cash market in gold. And what we can see here is really the type of bottom we have just witnessed in gold. And as you can see from this chart, this is our current print, 1655. Coming off of the lows, you can see the high that it made, 1670, right in here. Market comes down about $20. And you can see we've got the market rebounding very, very nicely. In terms of a technical basis, and when I take a look at this chart, what stands out to me is that we are having really a series of lows that are higher, indicative of a marketplace that's moving up, indicative of a rally. Next thing you want to see is the highs that we're seeing, new highs. And in that case, there really isn't. We are getting some resistance in this area. This I call a scouting party, checking out the fortitude. But as you can see, when the market attempted to take this 1665 area out, let me kind of carry it over, it was unable to sustain any kind of long-term rally, came back down, but it did make a higher low when we compare it to the recent lows on the 17th and the 18th. To me, that bodes very well for bullish sentiment and a continuation of the rally, this first rally of 2012. Now, if we want to take a look at trend strength, we'll want to look at our Henkin charts. It's quite apparent that this marketplace, it's still in green. You can see we've had these points of consolidation. Let me go ahead and blow that up. But this market has really stayed true to course in that as it found this bottom, this is that 1520 area that you can see right in here. You can see that we've pretty much had a one-way market when we look at our daily Henkin candles. We have an absence of wick today on the lower end. That's what we look for. But the second thing we look for in terms of the strength of the trend is really the size of the candle itself. You can see this is a rather large size. You compare it to the other ones, and you can see that that range is really shrunk when we take a look at it in here. And so for that reason, we don't see a very, very strong trend, meaning the trend picking momentum up. Rather, it's been consolidating and then moving nominally higher. That to me bodes well again, because when we see this marketplace take off, what we really want to be able to witness is those quick rounds of profit taking, because that kind of is a valve that will keep any kind of a large sell-off at bay, because you're releasing this energy at strategic points. Where do I see resistance at? Well, there's really a couple of places you want to look at, and they're all clustered around 1680. And what I look for is I look for historical information as to how the market reacted. You can see here it's very supportive at 1680. You can also see here it is resistance at 1680. So the market kind of flipped back and forth on that. And the other thing worth noting is that when we look at our daily chart and we look for the one gap that we had a very, very large gap. And that was as this marketplace came up. Let me kind of point that out to you. This, again, is just a daily candlestick chart. But you can see this is that June-July rally we had last year comes up, and you get this one gap, that price void, which occurred right in here. And you can quite easily see that this gap here, of course, it came back and was backfilled right in here. Here you're seeing this area forming resistance, breaks through. Here again, it's support. And right now, at least currently, until we break through this area, it is resistance once again. Now, for those of you who have had the opportunity to read my latest article in Kitco, I talk a little bit about different kinds of forecast models. Primarily, the forecast models on Elliott Wave are so heavily dependent on using benchmark wave 1, and that gives us kind of some criteria to build those models with for wave 2, wave 3, and wave 5. Of course, wave 4 is going to be a retracement percentage of wave 3. So last night I did a little bit of modeling, and all I really wanted to do was, and realize it's very, very early because we don't have any kind of a complete wave count yet, so that I can begin to do the 61% retracement here. Look at this as a 1.38 extension, again 38% retracement, and then wave 1 equaling wave 5. It would look something like this as a classic textbook case. Traders, gold doesn't trade as a classic textbook case. When you think you really understand it, that's when gold changes. That's when you'll hear things like it's no longer safe haven, but risk on, risk off. So the best knowledge I can impart to any technical trader is the realization that we always need to learn a lot more. There's so much more that we do not know when we compare it to what we do know. But I did want to share this potential model with you. As I say, it's a little bit early, but by using the basic tools and benchmarks, assuming that this market goes to, say, 1684 and realize the high is about 1670, but assuming that that is the termination of wave 1, you could get a scenario, something like this, that would take you to new highs, would take you to just shy of $2,000 per ounce. Lastly, we want to look at the stellar performer lately, which is silver. Silver is absolutely having a nice showing. Traders, you know that I have kind of labeled a level 3084. I've called that resistance. It's a number that comes back time and time again. It's got some history behind it. You can see it being supportive here. You can be at supportive here. You can see when it breaks through this, you get a strong break to the downside. So there is some history. And what I am noticing right now is the fact that we have attempted to take this strategic area out on a couple of occasions, but quite honestly have been unable to. You can see we got our first test of that area on today's daily Henkin candle, but by no means was it able to just kind of run through there and trade above it. 3084, we're in at 2810. We've got some nice profits in there, but when we look at our Henkin candle again, it's a nice size candle, and we have the absence of this lower wick. Tells me that at least for now, there will be some attempt to break through this area. If we see there's difficulty there, that's a real good point for us to pull profits. If it breaks out and moves above, that's a point we might want to just hold or even aggressively add. But those are decisions we will make as the market goes back to that point. Again, that's only about 30 cents from here, and it actually has tested it as an intraday high. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow on Friday for the weekly review. Bye-bye.